This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover a range of topics listed here. I want to give some examples of extremes that we're seeing right now and to follow on with a lot of them I've pointed out in previous sessions. I want to talk about warning signs. I want to talk about this concept of not fighting the Fed, which has stood everybody in good stead for many decades. I'm calling it into question at this point in time. Who is actually winning here is something we need to talk about and what lies ahead. Last month, after outlining the agenda, I stated that the bottom line to me is that presently I see volatility increasing with a major market correction likely beginning with the July options expiration and lasting into the fall. It appears we were correct from the macro markets overall, but with the S&P still levitating at its prior highs. There is an old saying, if it looks like a dog, barks like a dog, and has a tail like a dog, it probably is a dog. Well, unless, of course, CNBC and the Wall Street sell-side community tell you it isn't. So what are you to believe? Trust your lying eyes or the pundits who didn't see the 2000 dot-com implosion nor the 2007 financial crisis coming? I lived through both as well as 1987. It was no different in each of those instances than now. The warning signs were everywhere, but investors chose to ignore them because of some perception that eventually proved to be false. This time the stakes are bigger than ever before, as the heights are loftier, the historical divergence is greater, and the world more instantaneously connected. The investor's psychological cycle never changes. There is always fear and greed. There are highs and lows that come and go in waves. Why they change, even Alan Greenspan said, was the great mystery that stood in the way of better economic forecasting. But we can have little doubt where sentiment currently stands, as every market dip is considered a buying opportunity, at least presently. So what makes this market one of extremes? I've outlined, as I said, many extremes in past talks, so let's look at some new ones which we haven't really focused on before. Consider CAPE, that is Shiller's cyclical adjusted PE, versus an inflation adjusted look at the S&P 500. We see here in red that the S&P 500 is very close to the 2000 dot-com high. The CAPE ratio, however, is considerably lower, but nearly equal to the 2007 pre-crisis highs. These are two separate but clear double tops. Minimally, we should draw the conclusion we have overhead resistance that is going to force some level of consolidation before going higher or completely breaking down. Warren Buffett is well known for the use of the ratio of market capitalization to a country's economic output. Only once before has it ever been higher, and yes, it could go higher as this chart technically suggests. This analysis, using gross national product as the measure of economic performance, suggests based on the red parallel technical channels that it may be overextended. It is likely somewhere between this graph and the last graph, but both indicate a near-term consolidation is likely. Consider equities as a percent of U.S. household financial assets. They are presently at a level only seen 2 other times since 1962. Clearly an extreme. Markets fell hard for a sustained period in both prior instances. Endless prognosticators have been talking about the lack of volatility and complacency in the market, and I have shown that on a number of occasions before. The VIX has seldom historically been this low, another clear extreme. Sentiment, as measured by bulls and bears, is also showing extremes. Here we see the current investors' intelligent sentiment readings. Bears are at a low not seen since 1987. FBN notes, and I quote, "It's more dangerous to have an evaporation of bears versus a plethora of bulls," end of quote. When we look at the bulls-bear ratio, we see a high we have never seen before, at least as long as Investors Intelligence has been making these measurements, which is longer than I've been in the business. What I have learned is that when everyone is on the same side of the boat, bad things normally happen. Considering how high the market is, it is surprising how few bullish Americans we have. That is because, in my opinion, the public isn't in this market rise. Their pension plans, however, are. This chart of CNBC viewership shows you how little interest there is in the markets by the public. They've been hurt badly twice in the last decade and a half, and just don't believe in nor trust the markets. The markets appear rigged to many based on the emails and comments that I receive regularly. It appears that things don't pass people's common sense. The markets don't square with what they see around them in everyday lives. They don't believe the shrills on TV. They aren't buying, nor are banks, insurance companies, pensions, nor hedge funds, and I've shown this in previous shows. What's happening is buybacks and buying by public funds and central banks rule the historically small volumes that are in fact trading. Yet another extreme. It is out of the question that the U.S. is approaching or near entering another recession, if you listen to the media. However, I don't believe we have yet stopped the cyclical nature of the business cycle. We may be closer to it than all the manipulated and massaged numbers would indicate. Europe is clearly in a recession. Except for one quarter, it has officially been in one for the last 7 quarters. Japan's numbers just keep getting worse despite Abenomics. We see here that European equity markets have rolled over, as has the Nikkei, based on weak economic conditions. Remember, Europe is the U.S. biggest trading partner. How is it that the U.S. is still the beacon for the global recovery? It isn't just the indices that are showing fatigue, but we are seeing some of the generals test or break key long-term trend support. Here we see Apple and American Express, a technology leader and a financial services corporation. I said earlier that extremes occur when the markets believe in something that turns out to be a mistaken belief. I believe we will soon come to the realization that monetary policy is insufficient to fix the global problems which are getting worse and are being left unattended to. The lessons of the financial crisis have been lost as we see credit and lending standards once again lowered. Dodd-Frank never fixed the derivative issues, which have only increased, and never addressed the too-big-to-fail banks. We papered over the problems due to excess debt with money printing and increasing debt. Markets have been tracking very closely, as you're well aware, to the increase in the balance sheet of the Federal Reserve. However, taper is coming to an end. This chart shows that the markets are presently well ahead of an already flattening growth of the Fed balance sheet. For the last 5 years, every dollar of quantitative easing has resulted in $4 of additional S&P 500 market capitalization. One thing I know about markets is that formulas that work don't last. The markets are always learning, adjusting, and changing. The ratio of every dollar of quantitative easing to economic growth has plummeted, and no longer creating growth. I would argue it is actually now becoming a burden to the economy as more debt means more interest payments which take away from savings and investment. The markets and economic growth eventually must have some sort of correlation. Liquidity is not collateral, nor is it wealth. It is interesting to see who is really winning within these market extremes. If you look at the markets less inflation, fees, and taxes, investors are no better off than they were nearly 20 years ago. The winner has actually been the government in terms of capital gains tax, investment fees, and registrations. A higher stock price keeps consumers spending and keeps tax revenues coming in. No one has a more vested interest in a higher market than actually the U.S. Treasury. This isn't unique to just the U.S. Here is the U.K. adjusted for just simply inflation, if you can believe the government's inflation numbers, and is a dismal failure. Let's consider asset class returns versus the average investor. The average investor is shown here in red. The market gains are simply not translating into the public's increase in net worth as much as we might have thought. Just holding the S&P 500 index for the last 10 years beats most actively managed funds. It certainly beats hedge fund returns after paying the 2 and 20 on gains. So what is going on here? As I pointed out previously in the $2 trillion tax ruse article and paper, corporations are borrowing money and taking tax write-offs on the debt, which is then being used to buy back shares to make earnings per share look better and reduce cash dividend payouts. It's a giant tax avoidance game to drive the markets, and the government is fully cognizant of this. In fact, it's achieving exactly what they want achieved, despite the extremes and the distortions. But the gig may be slowing. The just released numbers suggest corporate chief financial officers may be getting leery about the amount of debt they are taking on and the reduced amount of capital stock in the market. This is significant. EBITDAs have been falling, and I've mentioned this many times, and cash is getting harder to grow organically. The difference between the blue line and the red line shown here must be borrowed, and in fact is being borrowed. Unfortunately, this is a play we've seen before. Another example of an extreme is shown here. U.S. corporate debt and equity buybacks ebb and flows in cycles. Corporations always seem to buy back shares at precisely market tops when they are borrowing the most to do it. After buying back shares, corporations are then reissuing shares as inflated currency to make stock-only acquisitions. The actual numbers presently shown by the dotted part of this chart are dated significantly. We are going to historic levels of M&A activity, which should be good for the markets. The always optimist analysts don't see any roadblocks ahead. Forecasts range from 2,100 to 3,000 on the S&P 500 for 2015. Our MTOP prediction suggests this is possible, but not before we have an important consolidation. This is not going to be the straight moonshot it has been since QE1 was announced. In real terms, our long-term MTOP is quite clear. The right-hand side of the M is presently being put in. This will take until 2015 or 2016 to complete. This is a very large scale, and in many years as it falls off and finishing this M formation with some very key long-term support lines, trend lines shown here. This chart shows the MTOP in nominal terms, as represented by the Dow Jones Industrial Average. Here we are on the left side of the MTOP with the anticipated consolidation correction shown. There is a chance that the consolidation may be shallower than this chart would indicate. It will depend on how the central banks react to the impaired collateral values when the market starts to correct or consolidate, because that is critical. They need the collateral to sustain the credit growth, debt growth. Not the liquidity, but translating it into debt. People don't lend money without collateral or some revenue streams that can be pledged. We are at historic extremes by almost any measure. I personally do not believe it is different this time. These are the most dangerous words an investor can use. That is, it is different this time. These are the words that are used when false beliefs are most prevalent. When risks are the most dangerous, it's called bait, and every trap must have some. There is always something very attractive in every trap. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2014 be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.